Thank you, Denny, and welcome back to the show. I am Joshua David, always having a good time and helping people with the financial literacy. Al, as we talked about in the last segment, you mentioned, it is the New Year's. People want to start those New Year's resolutions,
Right.
but most people don't follow through them because of lack of a plan. And without a plan, it's hard to put odds in your favor or the probabilities, right? So let's talk about that on this segment here. Before we get into multiple assets, let's talk
Mhm.
about some of the things I guess investors can potentially do to hopefully gain an edge.
Right. Well, I'm glad you brought that up. The word edge, the word odds, the word probabilities, because that's one of the things that's part of our education. It really is, I think, a two-step process. One is identifying the turns in price, and I'll talk about that in a minute. But the other is putting probabilities in your favor, high probability trades. And I mean, that should be the goal, is to do something that more often than not is going to go in the direction you want it to go instead of the direction you don't want it to go. I mentioned proper risk management as being part of that first step too. And then the second step is identifying the right assets. But in that turn in price, that's really the key thing, because there's three components to every trade. One is proper entry. One is a proper in two. There's two exit points. So there's proper entry. There's an exit if you're right to protect your profit, and there's an exit if you're wrong to protect your capital. How do you do that? How do you find that proper price? And that is what will end up identifying a quality trade. That's one that has a low risk entry with a high probability of going in your favor with a high profit potential. And what we found, there is nothing out there that is 100% that works in every potential situation you can think of, but there is something that happens on a repeatable, very reliable basis that we can utilize and achieve consistency with that. And that is activity by institutions that change price. And what we found is that those quality trades I mentioned, high probability, high profit trades, happen at or near the turn in price. And that turn in price happens because of an imbalance between buyers and sellers, big buyers and big sellers. So if you can identify those points where that's going to happen, that gives you that opportunity to have the proper entry point, which will determine or dictate the proper target and the proper stop loss. In order to do that, you have to really, what we're doing is showing you how to find something that hasn't happened yet. And that sounds kind of crazy, but what we're looking for is orders that haven't entered the market yet, either buy orders or sell orders. And the institutions, fortunately for us, telegraph that information to us. So with a foundational strategy that our students use, we call it a core strategy. That is what that does. It identifies where those unfilled orders are sitting, unfilled buy orders, unfilled sell orders, so you can already have your orders set to be in or out before the institutions actually make the next part of a trade.
That's a great point there, Al, because a lot of people think that the public or the retail investor actually moves the market. It really doesn't. It takes a lot of money, millions and billions of dollars, that's moved into these markets and turning the price. And that's the institutions, the banks, the Goldman Sachs, the Merrill Lynch, the Buffetts of the world, right? And if you think about it, when they do that, they leave a footprint behind them, because when they're doing that, it's going to impact that price, right? So that's where Al's talking about. You need a core strategy to help you identify that on a price chart. And that's where they telegraph. I mean, think of it this way. We just had a little bit of snow this past week, and it sounds like more coming up tomorrow. If you walk down the road or if you drive through that, what do you leave behind you? A footprint. That's the same thing that happens in the financial markets, is the institutions leave that behind them. And that's what you want to identify. Opportunities into the market with low risk, high opportunity, and high probability entry points into these markets. Al, we mentioned earlier in this segment, the institutions are not just trading stocks, they're trading other assets. Let's talk about those other assets, some of the opportunities to really be properly diversified as well.
Yeah, well, why would they be trading something different? Why would they trade something other than stock? Well, maybe there's some better opportunities with other things. And when you think about short-term needs, in other words, generating cash from the market on a short-term basis, that's a different kind of strategy than Wall Street puts most of their clients into. Most clients are in a long-term buy and hold strategy. And that strategy, if used properly, and that's a managed kind of a buy and hold strategy, which is not what most people are doing. They're just putting money into a portfolio and then they're told to hold on to it for maybe decades. Well, if there is a need for cash on a shorter term basis, or if the institutions want to boost their bottom line and provide profits on an annual basis, they use something other than that long term strategy. There's short term trading vehicles that are utilized that we all have access to. And it's ironic that the institutions, which oftentimes you are clients of, are not putting you in those kinds of strategies. They're putting you in something different than they're doing, and that's basically the short term kind of trading vehicles. We're talking about the futures market, the foreign exchange market, and the options market. And there are benefits there that the institutions realize. We call them the smart money. That could be the big firms like Goldman Sachs or guys like Warren Buffett, the big hedge funds. They're out there trading pretty much on a daily basis. You don't have to do that unless you want to trade on a daily basis. But there are short-term vehicles you can use for maybe weekly or monthly additional cash input, because you know that the bills are always going to be there. That's a constant. And for a lot of people, unfortunately, the outflow exceeds the inflow, or it's very close to it. So a lot of people are looking at other sources of cash, other sources of, let's call it, income, which is simply in the markets. That's just cash from your trading. And they're looking for something that they can utilize. It may be the markets. That a lot of people that come into our classes are here because they're looking at the financial markets as one choice that they might want to look at.
It's a potential that they have.
It's
they're
a potential.
Exploring their opportunities.
Right. And that's the great thing about these classes that you're talking about. It's a great way for you to come in and just kind of test the waters, see if this is something that is right for you or not. And that's important to know too. But the shorter term vehicles that the institutions are using have a number of advantages. Futures and Forex, for example, trade basically 24 hours a day. So you have a lot of versatility there as to when you trade. They have great leverage along with options. And that leverage is a potent tool that the institutions take advantage of. Leverage simply means that you are maximizing the value of your dollars. You're just, it's sort of like a down payment on a house. You're kind of making a down payment on an investment. So it requires smaller amounts of money to control a larger overall investment. And that's just simply being wise with your money, maximizing the value of it. That's what the institutions do. These assets that I mentioned, futures, Forex, options, can be used in up markets, down markets, sideways markets. And if you're not participating to your benefit in a down market, then you're missing out on close to half of your lifetime worth of investing opportunities. So the smart money knows how to take advantage of a bull market. They know how to protect their profits from a bull market, and then they know how to take advantage of a bear market or a correction. And you can't get away from that. That's part of the market. It always has been, always will be. There always will be pullbacks. It may be a 10% or 12 or 15% pullback. It may be a 20
this year
to
we've
60
seen a 31% pullback.
Absolutely. This year we've seen many. In fact, over the last couple of years, we've seen a lot of pullbacks in these markets, short term. But every time that happens, your portfolio has to fight out of a little bit of a hole or maybe a big hole just to get back up to where it was before any profit can be made. We talk often about the impact of a 50% drawdown in your portfolio. Your portfolio now has to be up 100% just to get back to where it was before. And the real problem there, that's wasted time, wasted opportunity. It may take 5 years or 10 years for that to happen. In 1929, when we had the major market crash, it took 26 years to get back to where the market was in 1929. And those are years that a lot of us just don't have a lot of those years left.
Yeah, the biggest thing that you lose there is time, that time of investment. And just to give some reality of a couple things. The market overall this year is up. It's around 11, 12% or so. Now, think of the opportunities that were missed, because Al was talking about up markets. He was talking about down markets as well. The market dropped roughly 30, 31% or so at the beginning of the year. It came back up. Now it's up 11%, roughly, totally. Mm-hmm. Now, there was a 42%, what's the word I'm looking for, return from the bottom to now. So those are opportunities that people are just missing out on in that buy and hold strategy. So if you feel like you're missing out on opportunities, it's time to learn maybe some different techniques and strategies that show you those opportunities for the potential of what you're looking for. And Al, you talk about, I guess, the reality of investing. What's really happening in up markets? What is really happening in down markets? Some opportunities that people do have with down markets. It's just, I guess I keep saying this word today. It's opportunity. There's so much out there that people just don't know about. So, Al, we kind of talked a little bit about, I guess, longer term investing in this segment. I want to continue that discussion on the retirement side of trading and investing.
Sure.
Some of the opportunities that people are missing out on when they are in that buy and hold strategy, but what they can potentially do maybe a little bit different. Because think about this, the institutions, the banks, they're not putting their clients in the same thing that they're doing. This is Josh and Al. We will be right back.